I think it's politicized when it doesn't need to be. I think it all comes down to a more diverse and a more inclusive team being a better performer, being a more well-functioning machine. But I think importantly, when people say there's a lot more work to be done on that, I think you should absolutely not be forcing it and doing it for the sake of claiming that you reached this ratio. What we're doing and currently working on very actively with our head of HR is understanding how do we get as many people from diverse backgrounds to get into the application pipeline, and that just purely based on statistics, you should end up with a more diverse outcome.
Hello and welcome back to Cutting Edge. In today's episode, we're joined by Nikita Semenov, an economics undergraduate at UCL and CEO of Blackelm Equity, a student-run ESG investment fund. Nikita shares where his journey began, as he went from feeling lost and overwhelmed to developing a clear direction for his finance career based on experience and mentorship. Join us as Nikita uncovers the mission of Blackelm Equity, where education meets real-world application through the investment fund's proprietary ESG scoring system. Our conversation explores the critical path to achieving net zero emissions and the significant role that policy has to play in curbing carbon emissions.
I think rushing for net zero is taking steps in the wrong direction. I think actually cleaning up supply chains, how the products are packaged, changing consumer behavior, I think that's much more important in the long term than just trying to use every single tool in the box to claim that we've reached net zero.
We also draw from Nikita's experience working in venture capital, particularly in evaluating investments through the lenses of social impact and sustainability. Now, let's get started. What stage that you can remember as early as possible were you initially introduced to the world of finance, and when did it start piquing your interest?
For sure. So a lot of people in my family are lawyers, so I was really always interested in the corporate world from the legal perspective. And I was originally thinking of actually studying law at university, but then really took a step back to reflect of where my strengths lie, and I realized it was more of a quantitative maths side of things that interested me more. Hence, I thought I could do better in that sector. So being interested in the corporate world, realizing legal career wasn't something I wanted to pursue, I started looking at finance. I got very lucky at my boarding school. We had a very good career advisor. So I went to speak to him for like an hour or two, and he really broke things down for me. At the time, I think it was JP Morgan that was recruiting for the work experience program. So I actually ended up applying for that, got rejected. And then they recommended that I apply for the summer school. So I did the summer school, I think it was between year 11 and year 12 during the summer. And that was really the first proper experience that I've kind of had, getting introduced to the world of finance. Although investment banking, we didn't do much investment banking. I think on my LinkedIn, it's actually strategy consulting for a fintech, because the exercise was to spend a week building a bank of the future. And then we had to present it at the end to the MDs.
That sounds really interesting. So
good experience.
With those first experiences, what were your immediate takeaways of the world of finance?
For sure. I would say at the beginning, it was really hard to reflect. I was quite lost. It was very overwhelming. I think a lot of the programs at the time were also very focused on educating the students as early as possible about the climate change and the importance of sustainable finance. Not something I was really exposed to before. So it really took, I would say, probably another year or two. So basically it really started getting somewhat of a proper thorough understanding just before uni. But, to this day, I think there's still a lot more to learn.
Got it. And then obviously fast forward to UCL. What program are you currently studying?
Yeah, so I originally started just UCL economics. Later realized that I really want to get as much experience before getting out of uni. So I managed to get onto the UCL with a placement year, which I started a month ago, and have been enjoying working in the corporate environment so far. And
living in London?
Yes.
That's quite an adjustment going from South East, or in Dorset, to London, isn't it?
Indeed.
I remember we were in York for university, which is just a lovely town and place and city and campus. £2 pints, which I miss dearly. Coming down to London for my first internship. Wow. I was not expecting that, but I've been in London for good 4 or 5 years now, and actually over time we start appreciating London more and more, but it does get intense. And obviously you've done a few working experiences. You're currently on an internship, if I'm not mistaken, but do you see yourself potentially sticking with London as a base for the foreseeable future?
For sure. I think, for still 2 years until I graduate and might do a master's, so I definitely see myself being in London for another 2, 3, 4 years. I definitely like the environment of a busy city. I quite enjoy the chaos. I like bumping into friends on a random, Saturday stroll in the park. I don't think that's something you get as much if you're living in the countryside. Although I would quite like to move around, so, potentially would love to consider opportunities in Dubai, Singapore, or any of the other, maybe New York financial districts.
So an international travel approach with work. It's
Yes.
great that a lot of finance companies in general are very open and encouraging when it comes to not just training programs, but work opportunities abroad. I think especially once you're fresh and young, that's the time to do it. We initially were offered a grad program abroad, but then COVID hit. And so unfortunately that scuppered the second rotation plans up. But I think it's great because, especially when we've got limited responsibilities, it just gives you the flexibility to have that. So I'm looking forward to hear how you get on with all things grad programs. But until then, one of the really exciting things which we're very keen to kick off and talk about now is Blackelm Equity. So perhaps it's best if you give us a bit of an introduction. What is Blackelm Equity? How are you involved? And give us a bit of a summary.
Yes, for sure. So I think the way I came to know about Blackelm Equity was actually a very big strike of luck. They were advertising on Instagram when I was just graduating high school. So I'd actually applied to start at Blackelm Equity as an analyst in May of year 13, and then interviewed just before joining university, and then September, October really kicked off. And what it is I think a lot of societies on campuses are really large. They've been around for quite a few years. They have very well-rehearsed structural processes. And when you join them, you kind of, you become the first-year executive, then you try to get the committee, then you become the president. But the amount of impact you can have is really quite limited because it's a much larger organization. It's like joining a big corporate versus joining a startup. And I always really thought that during uni, I would love to experiment and join something a little bit more flexible. Hence, I applied to Blackelm, which at the time was 5 people. It was started out of Warwick with a vision to really create an opportunity for students trying to break into finance, to get a proper experience of real-world investing, real-world ESG analysis, as opposed to just writing equity research reports that no one really tends to read, and really having responsibility of the position that you recommend on the market. And joined that with one other guy from UCL, with the rest of the team being in Warwick, and then really realized that being in Warwick is great, but there is a very large population of students wanting to break into finance in London. So I went to the founding team and I really proposed opening a HQ London office, which is what I've been busy with for the last year and a half, and have grew the team to around 30 people in London now, handed over the organization to an LSE student who's been taking kind of the daily operations under control, and have stayed in a more of advisory kind of head of strategy role, working on partnerships such as with Financial Edge.
We're very excited to be partnering with you guys. You're doing some fantastic things. And if I was to clarify in short what Blackelm Equity is, it's a cross-university student-run investment fund.
It is indeed.
And what are the logistics and implications of the fund itself? Is it something which various universities club together to provide? Are you sponsored by external firms? And what's the total capital under management?
Yeah, sure, for sure. The way we operate is we have one partner, essentially one OP, but we don't have an FCA license, obviously, so we cannot take the money under our own control. So it operates essentially as an investment advisor, providing investment advice with full disclosure that is done by students and not a professional finance company. And then the partner, the founder, then essentially chooses to remain in the partnership if he likes the idea of the investment advice that we provide, and executes on his own account, sending us confirmation. There's actually quite a few other student clubs doing that in the UK. You can look it up. I think there's a very good page on Investopedia which really explains the logistics. It's called the Investment Club. It's the most transparent and easy way to operate such organization with no implications with FCA or any tax authorities.
Understood. So there's no need for becoming an authorized firm, nor appointed representation.
No.
That sounds like a fantastic initiative for any universities not doing something along the lines. I know back in York there was a Griff investment fund, which was a society doing something very similar based on an allotment of, I think it was £10,000 by a previous sponsor alumni working in finance. But I think it's such a great initiative, and it's one of the reasons why I wanted to partner with you, is because you're not just educating students, you'll give them real world application, much as Financial Edge aim to do with our online courses, programs, events. And for someone who is considering joining Blackelm Equity or a student-run investment fund in general, what can they expect and why should they join?
For sure. I would say we operate quite differently. I like to believe that Blackelm operates at the very much top quartile. I can only speak for Blackelm in authority, but the way we operate is that there's a split of 5 sectors, the usual, TMT, consumer and retail, FIC, alternatives, green energy, pharmaceuticals, healthcare companies. We operate in very small lean teams. So it's a sector head with 3 analysts on the team. When you first join some investment clubs, we will have a training program for you. We operate under such a slightly different model. We usually take people who have already done a lot of preparation in their time, so we don't really need to go through the boot camp essentially, so they can really kick off on the first day. We do investment committees, investment meetings every month, every 6 weeks, where the teams come together, they present. Then there is a completely transparent and democratic voting procedure. As long as the company ranks 3 out of 5 or above, it then goes to the MDs. The MDs are usually the sector heads that got promoted from the year prior. And then the MDs really work with head of risk to develop a best allocation on the asset.
Interesting. It sounds like a very thorough and well thought through governance structure.
It is.
Because that's one takeaway from, we were doing a finance conference in York at the, let's call it annual AGM, where it was the president, the chairman, the vice presidents. When it comes to enacting change in a well-embedded, strong society, in our case, it had been going for at least 5 years plus. It can get difficult if there are, let's call it constitutional documents setting what you can and can't do. And when the governance isn't particularly clear, you can spend easily hours trying to rewrite everything. But in your case, it seems like a well-oiled machine. It's very smooth. There's no quims when it comes to enacting any change or improving investments. It's quite a streamlined process.
It is indeed, yes. We've really worked very hard on that. And I've actually gotten advice from ex-finance professionals. So last year we were working with asset managers. We were working with ex-head of distribution at Goldman Sachs, ex-CEO of a top 3 asset managers in the world. And they really looked at our operations, how we work, our governance, and provided us some very useful advice that we took on board and have changed a little bit. And that has come to fruition, I think, in a very good way. And starting off this cycle this year, I think the new members will really feel that we keep up, stepping up our game.
And in your own words, what is Blackelm's mission and vision for the future?
Yeah, for sure. So I think to simplify it, really, it's access and education. I think a lot of people see investment banking, a lot of people see asset management and all the other finance-related careers, but it's really hard to really understand. And I think personally, until you really try something, you don't know. So we really provide that access for students to try something out while they're still at uni, understand if it's something they want to do, and then go into a graduate role, for example, or an internship, having had a chance to really have a more thorough understanding what they're about to do. I think a lot of people, when they join uni, they feel a lot of peer pressure to apply to asset management or wealth management, private banking, but they don't really know what it is, right? We really provide them that feel for them to be able to make a cautious decision that, yes, this is something I want to do. And so that's access. And then education, I'm a very big believer in learning through mistakes and learning through actually, getting stuck in and getting your hands dirty. We really do provide that platform. Again, as I'm saying, a very democratic, transparent voting procedure. Quite often it doesn't work out and, we lose money on the market. And then we go back, we try to understand why didn't this investment work, what we could have done better, where we didn't read the news correctly. And through that reflection, through that, reiteration process, I think students really get access to something they would only get not even probably during the internship. I don't think during the internship you would get access to that part of portfolio management.
And in that sense, again, to clarify a bit further of the actual mechanics of the investment, because obviously it's technically investment advice, but disclaimed by students, but there's still a fund that's being managed and you're ultimately deciding the investments that are being made, if I'm not mistaken. And then that capital itself, are you able to disclose the total AUM of the fund?
Yeah, for sure. So it's 250K under direct advice.
Understood. And then do you have set objectives and holding periods for the investments you make?
Yeah, so we operate under quite an opportunistic model. I guess the core structure is macro-driven, ESG integrated, meaning a lot of our kind of analysis is top to bottom, and we have not just an ESG filter, but a proprietary ESG scoring system. A lot of that I learned during my time at Impacts and try to really implement, proper world-leading structure into what we do. And then in terms of holding period, really depends on investment to investment. Some of our investments we kind of did just before the quarter update. We really felt like we had an edge and that we had good, interesting analysis. So we were doing the investment 1 week before, sell 1 week after and make 20% in 2 weeks. Some of our investments we've, for example, not done so well. They're 60%, down from the investment date, which was 2-3 years ago. But we do believe in companies long term, so we recommend our partner to keep holding them. Some investments we short. If you short, then we really take a more of an active management perspective. We see how it's performing. But yeah, I would say the holding period can really vary investment to investment.
Sounds almost like a hedge fund.
I mean, student-run hedge fund, right?
Yeah, it sounds really exciting. I can't say of any other opportunities that have that level of different types of investment. The short is particularly interesting because you hear stories of the likes of Bill Ackman shorting Herbalife and, how great or how badly these shorts can go. And then it feeds into things like, calls or other options to hedge your initial investments or cap the loss or gain you can make. But then having said all of that, going back to ESG, that's one of the key pillars of Blackelm, from what I understand. On a side note, if you haven't already, please subscribe to our channel. You'll be doing us a massive favor. You can keep up to date with our latest content, and the bigger the podcast, the bigger the guests. So breaking down the environment, social, and governance structure of an investment, what is it, and if you can give an example even better, what is it that sets your investment approach focused on ESG apart from others or other companies?
For sure. I think for us, when we say ESG investing, it's obviously not impact, right? We are still investing for financial returns, but we do take a very accurate and a very cautious approach to what we touch and what we don't touch in terms of investing. Everyone who out of interviews for the position really knows how much I care and what sort of questions I ask. And I really try to educate the members on, understanding it's not a plug-in approach. You cannot take the same approach and analyze a manufacturing company to a software company. They have completely different supply chains. Essentially, one doesn't. They have very different structures. They're located in quite often different geographies. To really not just trying to tick boxes, but actually understanding the business model and really breaking it up, reading the entire 10K, seeing what they're doing, what measures they're taking in place. Are they really trying to reach net zero? If they're claiming they're trying to reach net zero, are those just claims or are they actually scientific ones that have been confirmed by a third party? And I think through that process, once you do proper deep ESG analysis, going into things like supply chains, HR practices, the board, how diverse is the board, in all aspects of diversity, you actually understand the business better. And if you understand the business better, you don't just filter for ESG, but you actually hope to make a better decision on your investment. So I think they go hand in hand. And I think at this point, it's really hard to make a good investment without properly understanding the, let's call it, ESG structure of a company.
And do you have a systematic way for assessing ESG across companies? If you were to take, for example, although you may or may not have access to the kind of investments such as renewable energy projects or a company who invests in offshore wind farms, for example, compared to, let's say, a Tesla, for example, an automobile car manufacturer. So what differences, if any, do you employ when assessing ESG for these different types of companies?
For sure. So I think in terms of how we've done it historically, it was very opportunistic. It was our members kind of taking investment by investment and trying to understand it. I wanted to implement a little bit more governance, as we spoke about previously, to make things a little bit more black and white in terms of what we look for. So we actually ended up hiring two people from KCL master's program in, I think one person was doing climate change and the other one was doing environmental policy. And they did a great job of really putting their academic research with their experience in working in asset management companies and working in ESG research houses to create a more of a, still not a plugin, but more of a template for what we look for. And now we split up everything here, by 3 letters, but not just that. We now know where to look for different resources. We also created some exclusion metrics. So, if, for example, on 5 specific metrics that we think have the highest materiality, there's a company scores below, for example, 3 out of 5 when we exclude it, and it's not something we can invest into. I think materiality is really something we're introducing this year. Hence, the work that was done by the KCL ESG team last year. That's going to be very interesting. Back to your question, Tesla versus a renewable energy company. The importance of specific metrics, their materiality is going to really depend. So actually, although a lot of people think that the fact that Tesla gets horrible ESG scores is unfair because they're creating sustainable vehicles, if you look at their supply chain, it's really, there's a lot of improvement to be made. More importantly, if you look at their social, into their social scores, their board, exactly a lot more in the development there to be made. So although the end product, the output, is of a very positive impact on the planet, if we exclude the batteries that go into it, the structure of the company is really not kind of ESG compatible. And I think what I said about looking at the product, not just the operations of a company, that's something I really learned at Impacts. Previously, ESG analysis was really linked on looking at the operations of a company and the supply chains. I think the best approach, which the top asset managers are now taking, is also looking at the product of a company, what effect the product of a service of a company is having, again, looking by the 3 letters of ESG. So, for example, you might have a company which doesn't have a best supply chain. They haven't quite narrowed down on making sure that they're using best practices in that. But actually, the output is the service or a product which is having a far greater positive impact than potentially something which is hindered in their supply chain. So then you really try to take a balance and understand: am I taking the risk associated with not as good of a supply chain for the benefit of having a company on my portfolio which is having or producing a really good product or service? So I think that's very interesting. Being a student-run hedge fund, we're a little bit limited in a sense of engagement. At Impacts, if they analyzed an ESG update for the company on a specific year and they thought that the company was slipping in one metric or the other, I spend a lot of my time doing engagements, talking with chief ESG officers, chief sustainability officers of S&P 500 companies, and asking them to improve something, really working along with them to enhance their companies. That's something we cannot do. So because we cannot do that, I guess the exclusion metrics are a little bit more harsh for us because we cannot have that follow-on positive impact on the company itself.
And do you guys do any reporting, or have you considered doing any reports?
So we do not do reporting in sense of like end-of-year updates on the impact of our portfolio companies. And that's because of what I was talking about with very varying holding periods. We're still trying to understand how to properly do that. Also, quite often when we do a short, for example, recently we did a short on coffee. And one of the reasons we did a short on coffee is because the supply chains are not very good. So actually, how do you then include that into your report? Because you took a short position in coffee because of a negative supply chains. So we would never, for example, go long on coffee. So we're really still trying to understand how to include that into the reports. It would be quite easy to do case studies and do kind of one-off things, but in terms of automating it, I think that's a slightly more difficult thing to do.
Yeah, and in that particular case, when you short coffee, is the practicality that you're shorting an exchange-traded commodity or product or fund in that sense?
Yeah, so in that case, we shorted the actual commodity.
Interesting, because going back to investment banking, we learned a lot about ESG credit ratings in general. And then beyond that, we also learn, just like you mentioned, that a lot of the ESG factors and emissions aren't in that top layer of production. It's actually within the distribution. I mean, I'm heavily involved in the wine industry as well, and it's all in the distribution, the packaging, the bottling, fitting bottles into, a crate or having that shipped off. So you're right. And actually it feeds into a very fundamental analysis view when you're looking at companies. And with the kind of structure you're after, you're doing as part of Blackelm, shorts aside, shorts is much more sort of arbitrage opportunity, opportunistic, and long holding periods in mind. Having a full 360 view of a company and any dangers, risks they have in their distribution supply chain or any of the above, that can be a factor to consider when deciding in the long term, is this a 3 out of 5 or above? And what is your take as a fund or personally on ESG credit ratings? Because this is something that's, I don't know how long it's been around, but I only really started hearing about this about maybe 2 or 3 years ago.
For sure. I think in terms of publicity, they've definitely gotten some heat recently. From first, point experience at Impacts, we did everything fundamentally in-house, bottom up, but also always looked and compared to the external providers. And the interesting thing is that not only do they all have different outcomes, so is this a good, is this a bad ESG score, they also use different actual scoring systems. Some do A to C, some do 1 to 5, 1 to 10. So then actually, how do you do that? How do you take all that into account? I don't really know, which is why we at Blackelm do not use any external providers. We do everything in-house. And I think that way you just essentially avoid having to worry about something which is not under your control.
Yeah, you can explain it better. And I think that's the key, is whenever someone asks you with regard to the advice you've given, what's your take, rather than hiding behind one or an average or weighted average of set of ESG scores. And there are so many different ratings. I mean, with credit ratings, you've got Fitch, Moody's and S&P. I can't say the same with ESG scores, but also partly because they're just still working out how do we do this and how do you weight it properly. And, it's shocking back when I was in banking, just how much weighting the environmental side of things had in proportion to the governance and the social side. And, social actually sometimes just gets swept under the rug. And it's not to say that the environment isn't important. It is. But then how on earth do you balance it? And then how do you assign a numerical value? You're right. It's very hard. It's not a science. It's more of an art. And I think your approach to looking at yourself and being able to sort of comment on that is really useful, and it will help you going forward in the world of asset management or private equity or anywhere in finance. ESG is now not becoming something that's more prevalent, but now almost a prerequisite for investments. And especially now we've seen so much shareholder pressure on these big investment funds that shareholders or should I say LPs will actually be under pressure. Because in the sense of, if this fund is investing in oil and gas, or it's investing in offshore oil platforms and grids, then actually investors go, well, no, we actually cannot give you these funds if they're institutionals in particular. So I think there is an alignment, and it's taking a while, and we're working towards net zero in the UK 2050. I think around the world, there's this sort of consensus 2050 is the right time to everyone aligned to be net zero. What's your take in general, maybe talking with Blackelm colleagues and also yourself, on becoming net zero and getting to net zero by 2050?
I think in this case, the process is much more important than the name of a tech of what's actually going on. I think if we get to net zero just because people are purchasing a lot of carbon credits, and quite often, if you look at it, there's been a lot of scandals where the same company purchases offsets in a forest or natural habitat, and then now 5 companies do the same. So then how do you do accounting on that? I think that's not the right approach. I think rushing for net zero is, taking steps in the wrong direction. I think actually cleaning up supply chains, what you're saying about how the products are packaged, changing consumer behavior, I think that's much more important in the long term than just trying to use every single tool in the box to claim that we've reached net zero.
And right now, it's incredibly topic. And when I say right now, just in case of delay between when this podcast has been recorded and published, it's the news of Rishi Sunak in the UK enabling these oil and gas investments, if I'm not mistaken, which is highly controversial. But there's two sides to the coin, and I like to explore this in a little bit of detail, where obviously we still have quite a significant dependency on fossil fuel energy, especially in the UK. We are the biggest offshore wind provider, I think, in the world. We've got some amazing technology, some great sites and whatnot. But having said that, it's still a small percentage of the total energy that we need for consumption in the UK. So what do we do? Is, in this case, not to put you on the spot if he's right or wrong, but what's your take in general about enabling investment in these sectors versus slowly trickling out and feeding more investment over time into renewables? Or do we need a hard stop in some capacity? What's your take?
For sure. I think here my experience doing VC is also coming in very useful. Just a couple of weeks ago, I was talking to a company out of Cambridge, and they are working on implementing sustainable energy resources into the electricity grid. And actually, a lot of people don't realize just how hard it is. The grids were built very long time ago. They're not capable of taking that much power from, especially varied power. You know, if you put in a lot of solar panels, you put in a lot of wind turbines, unlike gas, nuclear, or any other, fossil fuel intensive energy resource, they're very unstable, very volatile, and grids just can't take that. So I think a lot of kind of claims online that, it needs to be a hard stop is basically impossible. Like, that's the reality of the situation. We need to be a little bit more realistic. I think encouraging policies, giving subsidies to change the supply, the grids themselves initially is very important, because at the moment there is a huge stock of companies, residential developers that want to implement solar panels on the roofs of the buildings, that want to implement electric vehicle charging stations, and unfortunately the government just has to refuse because the grids cannot take that. So I think everything needs to be done in steps. From what's happening kind of, I guess, on the ground, the clear issue at the moment is the actual grid. So until the grid is modernized to take more volatile, more volatile supplies, unfortunately, fossil fuels is going to play a role in the economy.
Yeah, it's another similar example is electric vehicles in the UK. It's all good if suddenly we get all these new investments or companies that are willing to make electric vehicles, but we just don't have the charging capacity or infrastructure either. So I think there's a lot of problem solving to be discussed, not just around bringing about this positive change of new electric vehicles, new wind farms, but like you said, how do we feed that into the grid? How do we realistically charge these cars as we go? And that's something that will inevitably take a lot of time, a lot of figuring out, and actually making it economical too, because a lot of the time it's not. And even the charging speed a few years ago was just abysmal. You'd be waiting outside a forecourt petrol station, waiting half an hour plus just for your car to charge, which, I'd go crazy if that was me doing that.
No, for sure. Especially, I think, with storage, with more volatile supply from the more, I guess, green, more energy efficient solar panels, wind turbines, hydroelectricity. You have to store it somehow for the night for when you don't have a wind blowing. And at the moment, there's just no economical way to do that in instances where you would actually be able to do that, because unit economics don't work. We're still essentially innovating in terms of chemistry, innovating in terms of engineering and how to do that. And in the meantime, I think feeding private investment into university spin-outs, university startups that are really trying to impact that and really speed up the process of learning how to do that, that's going to play a key role in the next 5 to 10 years.
It's interesting you mentioned that, because the first thing that came to mind was Bill Gates's visit to London, and there was this sort of joint venture collaboration between, I think, Imperial and the likes of these big tech or VC related companies, whereby these massive grants or funding has been enabled in order to combine academic research with corporate development and expertise, because I think you're right, that has to be the combination. People who are at the forefront of academia in their space and research, but then with that practical application that sometimes could be missing.
For sure. I think that's exactly the point. Just need to be a little bit more realistic about our expectations.
And actually, VC, I really want to get your take on venture capital. I myself have been to many events in the space. I was at one yesterday, the day before yesterday, and it was ESG came up, and then the question was asked to the judging panel, some big technology company listed on the NASDAQ has just made a questionable investment with regard to ESG. What's your take? Some was saying, we do an approach whereby if it's not harmful, then it's okay. And then there was a follow-up, but then that's not ESG investing in that sense. From your experience in the venture capital world, how is ESG factored into decision making? And also, how does venture capital compare in general to the world of, say, asset management, hedge funds, or private equity?
Yeah, for sure. I think the term ESG in practice doesn't really exist in such early markets as VC. I think it starts to come in a little bit more in growth equities company scale. I think in VC, the way you look at investments, trying to understand, are they sustainable, are they having positive social impact? It's actually done on case-by-case opportunistic model. Some VCs specialize in making clean climate, green tech investments. For them, obviously, that's their mandate. That's what they do. That's their bread and butter. I think for other VCs that invest in a more varied set of companies, for them, most founders that come through a pipeline just understand that not even because of consumer pressures now or because of ESG on the news, they just understand that businesses and their models need to be future-proof. And for your model to be future-proof and really fit into the kind of more digital, cleaner economy, they just understand that themselves. And more often than not, when you speak to founders, you try to understand their business models. They subconsciously, without even targeting ESG specifically, like there's no ESG slide on a VC presentation, you just understand that subconsciously the founder has built a better, more sustainable, more ESG, if you want, business model.
Sure.
And then I think the second part of the question, in terms of working into industries, I've been very lucky to experience both ESG, growth equity, and asset management. Happy to go into more detail if you have any more direct questions. But I think generally it just fits a very different profile of people better. I think people that want to do asset management, they really like longer term, more slow approach to research, really understanding one company for a very long time, following that one stock for your entire career, and building a basket of stocks, calling that your portfolio, and being really the expert on that. I think that's what fits people that want to do asset management a little bit better. People with VC, growth equity, quite often they're more generalists. They like to bounce around, a little bit more chaotic. They prefer to study and educate themselves on a bigger variety of companies. And it just fits a person who is a little bit more dynamic in their couch or in their nature, I think, a little bit better.
It's true that a lot of VC funds have specific mandates, whether they need to invest in climate tech or agri-tech or all these other verticals, mostly tech, I've come to find over time. Having said that, a really interesting model is Octopus Ventures that I've come across. Again, I'm no expert in the VC space, but the fact that their ultimate company, Octopus Energy, and then they also have Octopus Investments, all of their subsidiaries all kind of work in harmony with one another to achieve their ultimate goal, which is obviously energy focused and more often than not renewable energy focused. And they could be investing in an electric vehicle charging company as part of their VC arm for their investments. They could be looking as big in the supply chain as the likes of an offshore wind farm investment. Then Octopus Energy, obviously they're doing a lot in the way of the consumer gas and electricity grid. When you combine all of that, I think that's quite an interesting model.
I think so.
Some funds or some VCs which are more like focused on one-on-one investments for a return.
No, 100%, I definitely agree. I think that opportunity to tackle the issue that you're interested in from different dimensions is a very interesting one. Currently interning, doing an off-cycle at BPI, which is a subsidiary of a German media company or holding media company, Börde. And they have a somewhat of a similar structure as well, where they have a VC arm where I'm interning, where they focus on, Series A, B, C investments. As a holding company, they might want to acquire a company. They also have subsidiaries that are interested in M&A. So I think that just essentially allows you to understand the market better, because what's happening in a specific industry in Series A companies is very different to the events that are happening in the publicly listed companies, very different to what's happening with incumbents versus neos. So if you then bring all that knowledge together, just essentially allows you to make better strategic decisions, I think.
The Investment Banker course by Financial Edge Training helped me to secure a full-time role in investment banking. During my third year at university, I came across the Investment Banker online course by Financial Edge Training. This equipped me with the valuable skills needed to succeed in investment banking, such as financial modeling, valuation, and analytical skills. By enrolling in the course, you can get the same training as new hires to the top investment banks, with our instructors being ex-finance professionals from the likes of Goldman Sachs, JP Morgan, and Barclays. When you pass the course, you'll be awarded with a CPD-accredited micro-degree certificate, which can easily be added to your LinkedIn profile. This will demonstrate your achievement to top Wall Street banks, helping you to stand out from other candidates in your applications. Get started now, just like I did with the Investment Banker by Financial Edge Training. And the last part of this podcast, save the best and most important for last, is diversity and inclusiveness. We've talked to a lot of our guests, trying to get to the bottom of diversity and inclusiveness problem, solution, story within finance, and we just want to get as many different opinions as possible. So that the first thing I'd ask is, what's your take on D&I within the internships you've been involved with, and also within Blackelm Equity?
I think my very kind of short take, maybe for the media, I think it's politicized when it doesn't need to be. I think there's a lot of politics involved where there should be absolutely none. I think it all comes down to a more diverse and a more inclusive team being a better performer, being a more well-functioning machine. I think that's a perspective that should be taken. From my own experiences, I've definitely seen that, more diverse in all aspects of diversity and inclusive teams just operate better. It's a much nicer experience. A lot of finance comes down to strategic thinking, strategic decision-making, and through diversity of thought, diversity of race, background, socioeconomic, you just get much more opinions from varied dimensions, varied perspectives, and that way you come to a better conclusion. I think that's what it comes down to. I've really much tried to do that at Blackelm Equity myself. I actually did some statistics because I wanted to update on how we're doing. We are 75% non-white background. One of our 5 sector heads was a girl. And considering that a lot of our recruiting, and this is for the London team only, comes from LSE, which is very heavy on international students, I think we are proportionally doing better than our kind of input set, which I'm very happy with. But there's definitely a lot more work to be done on that. But I think importantly, when people say there's a lot more work to be done on that, I think you should absolutely not be forcing it and doing it for the sake of claiming that you reached this ratio. I think at the end of the day, you're still trying to build the best team you can. And the way to do that is not during the application process, try to solve for a specific ratio. What we're doing and currently working on very actively with our head of HR, head of recruiting, is understanding how do we get as many people from diverse backgrounds and different backgrounds to get into the application pipeline. And that just purely based on statistics, you should end up with a more diverse outcome. I think forcing diversity post the application is the wrong aspect and the wrong path to be taking.
That makes sense. It's so important to keep a lid on a manageable process and systems, as opposed to when you're stretched thinly, it takes away from the ultimate delivery or execution of what you need to do, which is invest funds and make successful returns and educate people. So I agree. I think it's a similar notion to slowly build out when you've got a manageable infrastructure. And if there's no D&I infrastructure within a said institution, build it, set the fundamentals, have some like key people spearheading that initiative, and then roll it out and get, content. I think is a great way, as is this podcast, for example, to get the conversation going. Now, whether it's, videos educating people on some of the stats behind it, why there are problems, what we're doing about it. So just understanding why there are differences in the first place. I agree. I think it's so key, and it's great that for a student-run finance society, you've got such great representation. I think that's one of the reasons we at Financial Edge were so happy to partner with Blackelm, is because not just of the educational aspects and progressiveness and obviously the network that provides, but I think your focus on diversity and inclusiveness speaks for itself. And I think for anyone listening who is in some capacity involved at Blackelm Equity, doing a great job, and I wish you guys every success going forward and continue to do the great work that you're doing in the D&I space. And for those listening who want to get to know more about Blackelm Equity, they've just heard about it for the first time, where can they go? What are the best socials or channels or websites to reach you on?
Yeah, for sure. I think we've got an Instagram page you can follow. There is a LinkedIn, there is a website which is most easily reached either through my LinkedIn or through Blackelm Equity's LinkedIn. For those that are based in London or Warwick, we will be opening applications around mid to late September, so stay tuned for that. And I'm sure if you do get on board, you will enjoy the experience, and it will be the one where you can really take charge of what you do. I myself came from an analyst to a very senior position, something which is still very much possible due to our startup nature. If you propose a solution, if you propose an idea, which is well outside your direct line of work, like I was a macro research analyst when I proposed opening the London office, still very much possible if you think you have a really good idea which we should implement. We are more than happy to do so, and you do not need to be stuck in your exact role, which I think is what really sets us up in a differentiation point of view from larger other societies. Where just by the nature of being essentially a big corporate, they are stuck to having very low sort of mobility within the organization.
That's great. Well, Nikita, thank you so much for joining us on the podcast. We've covered ESG, Blackelm, diversity and inclusiveness, differences between some of the industries. So there's a lot for people to digest. And we hope people have enjoyed this podcast. It's great to have a chat with you. Wish you all the best with Blackelm, and obviously we'll be in touch with our new partnership. Good luck with everything, and we'll speak to you guys very soon.
Thank you very much, Tom. It was my pleasure, and looking forward to our collaboration.
Thank you. Thank you for listening to Cutting Edge. If you enjoyed this episode, please like and subscribe. It helps us out so much so that we can continue to build our podcast and deliver more episodes just like this one.